Stephen Koukoulas here and presenting our update for Zagga, and as the economist in residence for Zagga, look, we're confronting some really interesting trends occurring in policy and in the economy. To policy first, we've had two big shocks, I suppose we could call them, in the last couple of weeks. The Reserve Bank hiked interest rates. Gee, people have almost forgotten about that now, but yeah, we saw that shock interest rate increase at the May meeting of the Reserve Bank Board. That took most people by surprise. And we've had the government deliver its budget with a budget surplus, which is, again, another interesting and important development in terms of how the economy is being managed. So let's take a step back on where things are. The bottom line is that the economy is still slowing. Both Treasury and the Reserve Bank are forecasting that. GDP growth to slow. Inflation is clearly on a downward trajectory. And in fact, one of the interesting aspects of the budget papers, which I think has been overlooked, is that one of the measures which is giving effectively subsidies to householders for their electricity bills will slice about 3/4 of a percentage point off inflation. Hence, Treasury has a lower forecast profile for the inflation rate over the next 2 years than the Reserve Bank put out barely a week ago. And of course, Treasury had the up-to-date information, Reserve Bank didn't. So we've got this scenario now that whatever deceleration in inflation that was happening is continuing to be sort of reinforced, I suppose, by slower growth, policy decisions by the rate hikes and in the budget. And so that we can be pretty confident now, even if we might have got the May rate hike called from the RBA wrong, but gee, that they're not going to hike again. It sort of seems to be impossible to think that there's going to be more interest rate hikes. So for the economy more broadly, weaker growth is coming through. We won't get around that. But in terms of the interest rate outlook, one interesting trend that's evolving is that the market is pricing in interest rate cuts. Now, the market's not always correct, but boy, it's interesting that the market's now saying that the economy is slowing markedly, inflation is falling rapidly, and that, hey, by the time we get to the end of this year or early 2024, we could be talking about and actually seeing interest rate cuts. Wouldn't that be interesting?